Germany, the economic powerhouse of Europe, stumbles.
Recovering strongly after the COVID-19 pandemic, the German economy is shrinking.
It seems to have run out of money that it needs for modernizing its infrastructure and for achieving its climate targets.
Some politicians and economists are predicting Germany's downfall after decades of stability.
For years, Germany is being renowned for its booming factories, luxurious cars like Mercedes and BMW, and its influential role in shaping the European Union. Remember those impressive Made in Germany labels? They were a symbol of quality and economic might, but lately things have gotten a bit shaky. Last year, Germany unexpectedly became the worst performing major economy, and now people are getting worried and angry about how Olaf Scholz's government is handling its budget. What's going on? Is Germany's economic miracle finally over? Surprisingly, the situation has become so serious that some voices within the country are calling for a German exit from the EU. Even the far-right leadership sees Brexit as a blueprint for Germany's future. This sentiment is reflected in the rising popularity of the Anti-European Alternative for Germany, or AfD party, which now stands as the second largest political force in the country. This party emerged in 2013 to oppose bailouts for struggling European economies like Greece and Spain, and its rise is a clear sign that things aren't going well in Germany. This situation has strained relations between Berlin and Brussels. So, what's the catalyst for this chaos? Let's rewind to November 15, 2023, when Germany's highest court ruled that the government's 2024 budget violated the Constitution's balanced budget requirements. The issue? The government planned to use leftover funds, 60 billion euros, from a COVID-19 emergency fund to launch a new climate and transformative fund, a key part of their environmental agenda. This fund aimed to invest over 200 billion euros in areas like energy transition, railway expansion, and advanced semiconductor manufacturing. The 60 billion euros was crucial for this ambitious project. However, the court's ruling not only blocked the transfer of funds, but also potentially jeopardized the entire project. The court essentially said that if the government wanted to spend money on this transformative plan, they would have to cut spending in other areas, potentially impacting social welfare programs. But why did the courts do this? And does this ruling spell trouble for Germany's usually stable economy? To understand this, let's rewind to 2008, when the global financial crisis hit Europe hard. But Germany weathered it relatively well. However, the government took a bold step. They changed the constitution to limit public debt. This debt break restricted new borrowing to 0.35% of GDP. It seemed like a brilliant idea. Germany was sending a message of fiscal responsibility. But some economists, like Alberto Alesina from Italy, warned that such rules might not be the best idea. They argued that raising taxes during good times rarely works, and strict spending rules make it hard to respond to crises. And guess what? That's exactly what happened. The debt break seemed great on paper, but in practice it got ignored. In 2017, during the refugee crisis, the government bypassed the debt break to help local economies. Then, in 2020, the pandemic hit, and the debt break was suspended again. Special funds with billions of euros were created to deal with the crisis. The story doesn't end there. In 2022, the war in Ukraine broke out. The government needed money to modernize the military, so they created another fund, this time for 100 billion euros. And that's not all. By this point, there were a total of 29 off-budget emergency funds. The German federal court checked it out and found out it's like 941 billion euros off-budget. Can you believe that's more than 20% of the country's annual GDP? Now, the government wants to do something similar to pay for climate and green energy initiatives. But this time, the courts have finally said enough is enough. They ruled that this new climate fund is illegal. The court ruling not only stopped the transfer of a huge chunk of money, like 60 billion, but it also put a stop to any future funds like that. It even put the existing funds under scrutiny. That's a big deal. And this is happening at a really bad time for Germany. Their economy isn't doing well. Even France seems to be doing better economically. Germany used to be a powerhouse, but now it feels more like a tired giant. In 2023, Germany's economy even went into a recession, and 2024 doesn't look much better. The recession that started in late 2022 is dragging on, and the worst part? There's no sign of improvement yet. So what could be causing this? Let's explore some possible reasons. First, there's the energy problem. Back in 2011, Chancellor Merkel decided to shut down all nuclear power plants in the country. But did she anticipate the consequences? No one could predict that it would lead to Germany relying heavily on Russian gas. They got comfortable with Russian fuel because it was cheap. But then, something unexpected happened. The war in Ukraine disrupted the flow of Russian gas. Suddenly, Germany was in trouble. Surprisingly, the Germans didn't panic. Instead, they got to work and found alternative energy sources in record time. But the new energy was more expensive. This hurt both families, higher energy bills, and businesses, less competitive because of the increased cost. Second, Germany has a talent shortage. German companies have an even bigger problem: finding skilled workers. With an aging population and a lack of highly qualified immigrants, companies are struggling to fill important positions. Imagine 77% of companies having trouble hiring technology experts. That's a lot. It seems surprising, right? A rich country with great opportunities, but not attractive to skilled workers from other places. Why do you think that might be? Tell us in the comments. The third move in this game is China. When China joined the global trade system, many Western companies faced tough competition, but not Germany. Their products were so advanced that China actually became a huge market for German exports, especially luxury cars like Mercedes, BMW, and Porsche. But then electric cars came into play, and so did new energy regulations from Europe. Suddenly, German manufacturers were facing higher costs and stricter rules. Meanwhile, Chinese companies saw their chance. They jumped into the electric car scene and started exporting like crazy. Now, China's on track to become the world's biggest car exporter, even surpassing Germany. That's not good news for German car makers. They might have to sell cars for less money, which means less profit. And guess what's worse? Chinese companies are starting to do better in China too. That's a big deal because Germany used to sell a lot of cars there. Volkswagen, a big German car company, is having trouble selling electric cars in China. Why? Well, Chinese companies have some advantages. First, they don't need to know a lot about old-style cars. They're good at making electric cars, even if they didn't make gas cars before. And second, China is huge. It's the biggest market for cars. So Chinese companies can make a lot of cars and not spend too much money. It's not just cars, though. Other industries in Germany are having problems too. Energy costs a lot, there aren't enough workers, and now there's competition from China. All these things are making it hard for Germany to stay competitive. And just when things couldn't get worse, there's a money problem too. The government doesn't have enough money to help businesses like they used to. This could lead to a big crisis where wages go down and people lose benefits. So, what can Germany do? They need to change things fast to avoid a big problem. Do you have any ideas? Let's talk about it in the comments. And if you like this video, don't forget to like and subscribe. See you next time.